If a trader is having a relatively smaller fund, obviously he needs higher percentage profit compared to a trader who is having a relatively large fund. So if a trader is trading, let us say, with 5 lakh rupees, 1% doesn't make any sense to him. But if a trader is trading with, let us say, 50 lakh rupees, 1% profit makes good absolute sense. Why I'm discussing this? Because in our ratio spread video part 1, when I said profit of 1 to 1.5%, many of our friends said our capital is small, so 1.5% doesn't make that sense. Agreed. So we said, okay, let us do something so that the percentage profits can be increased. We will be doing a lot of videos in lot of strategies. Some of the strategies will be useful for people with lower funds, and some of the strategies can be done by people with higher funds, because once your fund size is high, safety becomes more important than percentage return. So welcome to another video by the Option School. This is your friend Pradeep Singla. This is part 2 of ratio spreads. If you have not seen part 1, I am giving the link in the top right corner of the screen. Please go through part 1. That's very interesting video. And this is part 2, wherein we are trying to find out how to double the returns in the strategy. Few takeaways from our previous video of ratio spread, wherein we talked about 1 is to 2 call ratio spread, 1 call buy and 2 calls sold. So first thing we said that, okay, for taking the same credit, we should go away as far as possible from the ATM strike, because all the risk is on the upside. So if you are very far away, even a big upside move can be tolerated by the trade. We also noticed that since strategy is dependent on theta decay, there is no risk on the downside, or there is no risk in the sideways markets also, only risk is in the upside. Thirdly, small adjustments can lead to the trade closing in the max profit tent area, maximum profit zone. Hope you remember that there was a triangle in the payoff diagram. Now the question is what to do to increase the percentage profit of the trade. As I said, many of our audience is having a relatively smaller fund, which is perfectly okay. Everybody starts with a smaller fund, and slowly, once things are working for you, you will scale it up. So the issue is, if my fund size is very small, I'm not at all happy with 1% or 1.5%. So how to increase this profit? Can there be a process where this profit can be doubled? This is what we are going to discuss in this video today. So there are two ways in which we can increase the profitability of the trade. First method is to collect more premium in sold calls. But the problem is, when I want to collect more premium in the sold calls, I need to come closer to the market, which definitely increases the risk in the trade. So I will not follow this method wherein I'm increasing the risk in the trade. That is of no use. What is the other method? Other way is that I reduce the margin requirement for the trade. So if for the same profit I am giving less margin, that means obviously my profitability will increase. So let us see how we can reduce the margin requirement for the same trade, almost taking the same credit. Our initial trade of ratio spread is 1 call bought and 2 calls sold. This trade required an initial margin of around 1.59 lakhs to 1.6 lakh rupees. What we will do to decrease this required margin is we will buy far OTM weekly call. This weekly call can be 1 rupee, 1.5 rupees, because it is not purchased for the purpose of hedge. It is purchased just to reduce the margin requirement. I will show you all the mathematics also. Remember, our trade was a monthly trade. So what we are doing, 1 is to 2 ratio spread in a monthly trade and buying one weekly call. Let me show you the numbers, how they change dramatically. So this is the original trade in Nifty 50, and as you can see, margin required is around 1,60,000 rupees. Now in this same trade, what we have done, we have purchased a weekly call worth rupees 2. So once we have purchased the weekly call worth rupees 2, now the total estimated margin reduced to 78,000. So this is a 50% reduction in the margin requirement. Earlier we were requiring around 1.6 lakhs. Now we are requiring around 78,000. 50% reduction in the margin with almost similar profit. We have lost only 2 rupees out of the total credit received. Can we further reduce the margin requirement? So we experimented and we found that instead of buying one call, FAR OTM weekly call, let us buy two FAR OTM weekly calls and see how much difference it will create. So we added two calls at a different strike price. So in this case, what happened? Total margin requirement became 68,000 only, which is a 54% reduction from the original margin. Now this can vary here and there a little bit depending upon which strike prices we are using and what kind of expiry is there. Since margin is reduced by 55%, let us see what it does to our profit. Very obvious. My profit will double. So in half the investment I am getting almost the same credit. आधे पैसे में उतना ही credit मेरे को मिल रहा है, तो obviously my profitability percentage will double. So let us check whether in the backtesting also the same results are there. So these are some backtesting results which we have shared in our earlier video also. For July, the profit percentage is 1.64%, August 1.31, and September 1.32%. We did the backtesting again. Now this time we purchased two calls for OTM weekly calls to see okay what is the impact on the percentage profit. Obviously the credit received reduced by few hundred rupees. Let me show you the actual results with a modified strategy. So after buying for OTM calls for July, our profit was 1990, which is 2.92% compared to 1.64. For August, it was 2.46 compared to 1.31. And for September, it was 2.58 compared to 1.32%. Almost the profits doubled. But then there is a word of caution also. We should not overtrade. Now, since the margin required is less, it should not happen that, okay, we are making huge number of trades in quantity. So what we conclude that yes, definitely weekly option buying can be a good margin optimizer. And this is true not only for ratio spread, but this is true for any general strategy where we have sold positions. And secondly, profit can be increased by adding one or two more buying legs, which are very cheap in price because they reduce your margin requirement substantially and hence the profitability increases. Hope you like the video. Please click on the like button. Please feel free to write to us in the comment section for any doubts and any suggestions. And there is a link given in the description to download TOS app. There are a lot of strategies we have given in that app also. And if you are new to the channel, please go ahead and click the subscribe button. Thank you. See you in the next video.